Good morning and good afternoon for those joining us from the East Coast. My name is Cynthia Sang, partner at Fairview Capital, and along with the team from Los Angeles Fire and Police Pensions, we welcome you to today's webinar titled Investing in Inclusion. Investing in diverse managers is the cornerstone of Fairview's existence since it was founded 26 years ago. We have witnessed the evolution of this market from its formation, refinement, and to its current state. Fairview continues to be a prominent investor in the emerging manager space and a constant advocate to the LP community that diverse managers have the ability to provide robust return and deliver sustainable value over time. Today, you will hear from President of the LAFPP Board of Commissioners, Brian Pendleton, followed by a fireside chat moderated by Fairview co-founder Joanne Price, featuring LAFPP Commissioner Belinda Vega, General Manager Ray Serrana, and Chief Investment Officer Tom Lopez, in a segment titled Introspection: How do we get here and where do we need to go? After the fireside chat, we have curated a group of specialized managers currently in the LAFPP program to share their insights on operating and building an enduring firm in today's environment. We will conclude today's webinar with a Q&A session and closing remarks from Dr. Kola Olafimboba, Managing Partner at Fairview Capital. Before we dive into this rich content we have prepared for you, a few housekeeping items. First, you should be able to download a copy of today's program book via the link posted in the chat box. Second, throughout the presentation today, please use the Q&A chat to submit any questions that you may have for LAFPP or for Fairview Capital. You may also use the chat function if you're experiencing technical difficulties. We will address as many content-related questions as possible during the Q&A segment. And of course, unanswered questions will be responded via email on an individual basis. Lastly, as part of Fairview's compliance protocol, I have to let you know that the views expressed today by the speakers are those of the speakers and not necessarily of Fairview. The webinar is here to provide for general information purposes and does not constitute as legal, tax, investment, or accounting advice. No user should act on the basis of any material contained in today's webinar without consulting legal, tax, investment, or accounting professional advice specific to their situation. All participant audio is set to listen-only mode today, and the event is being recorded. And without further delay, I would like to ask President of the LAFPP Board of Commissioners, Brian Pendleton, to join me on screen.
Hey everyone, and thank you for joining us. We really appreciate it. Of course, everyone in the world has decided to text me right now, so these opening comments will be associated with a bunch of dings. I apologize for that in advance. Before I get started, I want to thank a few of my fellow commissioners who decided to join us today. We're really grateful that Commissioner Pedram Salmanpour, Commissioner Corinne Babcock, and Commissioner Belinda Vega are with us. Thank you so much for being here. You know, for me, this is incredibly exciting. You know, we're reaching out to managers like you to let you know that we're looking for you and that we want to invest in you because we believe in you. And that we includes this entire commission. Every one of us has voted unanimously to support this emerging manager program along the way. In fact, a few years ago when I asked the fellow commissioners if we could add the LGBTQ community to our definition, They voted unanimously to support that effort. And when we wanted to add more money, we voted unanimously to support that effort. And when we wanted to add another consultant to help us find more managers like you, the vote was unanimous. And it's not just the board, the 9 of us that support this program. We also have the unwavering support of staff. And you know how important that is. Led by Ray Siriana and Tom Lopez. I'm sure many of you know Tom, preeminent chief investment officer of our pension, well known around the states, has incredibly shepherded this program. And we also have the support of our partners and most importantly of our members, because really that's why we're here. We absolutely, first and foremost, must return money to this pension for our members so that this pension is around for a long time. But here's the good news. We know that the Emerging Manager Program works. It's already a success. We've been successfully investing in diverse managers since 2007. And as that success compounds upon success, we strategically added to this program. And that brings us to today. One of our biggest challenges is finding quality managers to invest in. So Leslie, Cynthia, Joanne, and the entire Fairview team partnered with the LAFPP team to create today's conference in the hopes that we'd inspire you to throw your hat into the ring and maybe tell your friends to do so too. LAFPP's Emerging Manager Program is open for business, and we want you. And by the way, once you've been successful in our Emerging Manager Program, we're going to kick you out of the nest into our core program so that we can make room for other emerging managers just like you. So we hope you get a lot from today's program. I'm sure you'll get a lot of very valuable information. And thank you again for joining us. And with that, I think I pass it off to Leslie Nettles.
Thank you, Brian, very much. Hello, everyone. Please let me add my welcome to each of you. We thank you very much for spending your time with us today. My name is Leslie Nettles, and I am a principal with Fairview Capital, and it is our distinct honor to manage a specialized program on behalf of Los Angeles Fire and Police Pension. And we are pleased to collaborate with them today to bring you the Investing in Inclusion event. To kick off the conversation, we thought that you would like to know a bit about your fellow attendees. With over 250 RSVPs, the audience is very inclusive with a wide range of individuals. From a high level, we have all different fund iterations, strategies, fund sizes. We have a broad geographic reach. And of course, most are ethnically diverse, women-owned, or both. To drill down in real time, we're going to ask the audience members to participate in a series of poll questions to get a sense who actually joined us today. Everyone who is listening to this event right now, please answer the questions that will appear on your screen, and I'll communicate the responses to the whole audience. You'll see them pop up and simply choose the answer that is most applicable to your fund. Can we please have question number 1? At the management company level, is your firm diverse? Please choose all that apply. Excellent. I hope everyone can see the responses there. An overwhelming number are women, and lots of different types of diversity are represented on in the audience. Question number 2, please. In what region is your fund located? As suspected, we really barbell the country with most represented on the East or the West Coast. Question number 3, please. What is your current or most recent fund size? Great, we have a nice range there also. Let's keep going to the next question, please. What fund iteration are you currently raising capital for, or what iteration is your most recent fund? That's great to see. We have a lot of first-time funds here and all across. Next question, please. How are you adjusting to raising capital in the current environment? This is an area we'll get into, I'm sure, as we talk to some of the GPs. Yes, all of us are spending a lot of time on Zoom. We have a couple fun questions coming up next. Do you currently work from home or the office? As with most of us. Next question, please. Zoom or phone calls? Where are you spending most of your time today or nowadays? And yes, most of us are on Zoom. And the last question, please. We had a little fun with this during rehearsal where we were all showing each other our slippers. Excellent. So we hope that was interesting and helpful to you. And without further ado, I'd like to turn the webinar over to one of our co-founders of Fairview, Joanne Price, who will introduce our esteemed client.
Good morning. My name is Joanne Price, and I am one of the founders of Fairview Capital. And it is my pleasure to introduce to you once again the leadership of the Los Angeles Fire and Police Pension. And with us today, we have Belinda Martinez Vega, who is a partner in the law firm of Venerable LLP, which is headquartered in Los Angeles. And she focuses on complex commercial litigation. She has been a member of the Los Angeles Fire and Police Pension Board since 2012 and was board president in 2015. Secondly, we have Raymond Serrana, who was appointed general manager of Los Angeles Fire and Police Pensions in May 2013 and has served as general manager for over 7 years. He leads the office with approximately 120 professionals and also overseeing the investment portfolio of about $25 billion. And then we have Tom Lopez, who has worked at the Los Angeles Fire and Police Pension System for over 40 years. So he has obviously loved his position and his vocation, and he has been the chief investment officer of the system for over 25 years. So thank you, all of you, for participating, and also thank you for your leadership in the program that you have established at LA Fire and Police. And the first question is for you, Belinda. As the longest serving commissioner, you've seen the evolution of the specialized program. Can you speak to how this program evolved since you have been on the board?
Sure. Thank you so much, everyone. And I'm so happy that you guys are all attending. It is such an honor to be here today. Thank you, Joanne, for having me be part of the panel. I echo Commissioner Pendleton's comments. We welcome you. We are open for business. We are excited to be part of a program that I think has evolved over the years, and we're quite proud of it. Our specialized manager program has definitely gone through a lot of changes, and we continue to commit funds to the program and are very excited to work both with Fairview and with our other consultant portfolio advisors. So, you know, I am the longest running serving commissioner that's been appointed, but Commissioner Navarro is actually one of the longest serving commissioners that's been elected. One of the things that I would like to say in terms of the evolution of the program is that it really took that generation, Commissioner Navarro and the commissioners that came before me, to teach me how important this was and how we needed to continue to work with Tom, have a very good relationship with our consultants, so that we were all on the same page in terms of what we wanted from our specialized program. One of the things that I think was very important that we learned through the process when we first started the program in 2007, we weren't great with metrics and really measuring ourselves in terms of progress, or being really disciplined in terms of our commitment, in terms of adding funds to the program. And I think we've learned and evolved. And when we finally created the criteria for our specialized manager program in 2013, we really put a lot of discipline into keeping track of whether or not we were making progress. We have a fiduciary responsibility to our members. So we want to make sure that we are being transparent, allowing people access to the program, while at the same time making sure that we are being successful in terms of the program. And I think we've managed to show that. I'm a big believer in metrics, and I think if we measure ourselves, we can make sure that we're meeting our goals. And I think we've been able to do that these last few years.
Thank you, Belinda. And Ray, what process did you utilize to put the specialized program in place?
Thank you, Joanne. I want to thank everyone as part of today's events. It's great to have sort of this gathering of such knowledge and such passion in this area. And likewise, I do want to give a shout out to Fairview and portfolio advisors. We would not be here without your help and assistance and guidance. It's really, we want to give a lot of credit to you, to both of you, for helping us get us where we are today. And so getting to your questions, you know, this plan has had a long history of of engaging emerging managers. Tom certainly has been around a long time, but we go back to 1987 with the first hire. This was in the public space. The first policy was put in place for emerging managers in the early 90s, and then grew from the public space into the private markets as well. And so as it has evolved, you know, we have looked to really focus on how we can gather and really put together a diverse group of general partners that could really push the ball forward, both in diversity, in ideas, in concepts, and really look at opportunities in those areas of the markets that perhaps a larger fund may not want to focus on. And so we look to those ideas, those folks, those GPs that bring in a new concept, a new approach to really putting together a good program. And we've been successful. You look at our numbers, our metrics, and we have had great success over the years.
Thank you, Ray. And Tom, speaking of success, how has the specialized manager program performed for its stakeholders, which of course, as everyone has says, is the most important?
Our private equity program started back in 1996. So the time periods are different. The specialized program started in 2007. But despite the core program being much longer lived, and the specialized program is right at the same level. They, by that we're talking low double digits, a multiple of about 1.5 times for both programs. And, you know, it depends on which quarter it is, which one is either ahead or slightly behind. But it's been remarkably successful. We haven't given anything up through the investments in the program, and we've developed a lot of strong relationships with firms out there that carry on into our core portfolio as well.
So just a follow-on question, Tom, to your comments. So what key tenets have you observed among the specialized managers, which are fortunate enough to manage capital on your behalf? What are some of the key attributes that you have seen through the development of this manager program?
We've wound up hiring a number of extremely motivated teams. These are people who, you know, have worked in private equity at junior levels or have left other firms or have specialized technical expertise that they're bringing to their fund. And they are ready to work hard. They are highly motivated to make their fortunes, to make their names in this area. All of the people in this specialized program like that share those characteristics.
Thank you, Tom. And Belinda, I have a follow-on question to some of your introductory comments. So how do you get something to move from a suggestion to a policy and then to implementation from where you sit and what you've done?
Right. I think it really takes the collaboration of the full board. I echo Commissioner Pendleton's comments. We really have a board that has been supportive, and we now have all of the members of the board asking our consultants the tough questions, not just for our specialized manager program, but for our full portfolio. What does diversity look like for the folks that we are seeing come before our doors? What are they doing to increase diversity? So we have, I think, the collaboration of all of our full board being supportive of our specialized manager program and being supportive of the fact that we need just more diversity in the space. That has been really helpful. I think working with Tom has been really helpful. As I said, we've been able to increase the fund size. And I think that's working with Tom and him being open to the idea of adding more funds to the specialized manager program, and working with Fairview and portfolio advisors and our consultants to make sure that they understand what's important to us. Joanne, you and I have talked about the importance of a pipeline. You know, one of the things that I hear as a commissioner is, well, I'm not quite there yet, but I want you guys to be paying attention to me. So I think working with our consultants, with you, and the importance of the pipeline, the importance of being accessible to these managers and saying, okay, you may not be ready this year, but we're paying attention to you, and, you know, please stay focused and stay in communication with us. We strongly believe that that's the way we create progress, making sure that we're showing them that we're open for business and showing them that we're paying attention early on, even when they're not ready.
So following on to that, how do you see yourself and your work as a member of the board, sort of being an agent for advancing the objectives of the specialized manager program?
Sure. Yeah, I'm very lucky. I have commissioners, I think, that are very supportive. And like I said, we're all on the same page, but I think it's completely an honor to serve on this board. I'm so proud of the fact that I'm a Latina, that I'm one of the few Latina that have served on the board, and that we now have a mayor who has increased diversity among all of LA commissions. But we're seeing the numbers. I mean, there are studies, there's a McKinsey study, there's a KPMG study that I'm sure all of you know, all of the people here, all our invitees are well aware of. Diversity matters. Diversity increases innovation, which increases profits for company. It's the same thing at the level of public pensions and investing. When we bring in more diversity, we get more innovation. So we're going to get better returns in terms of our investments. And that is bottom line what we care about. So to me, I just see it as very important to be a champion. Well, you know, everybody has to meet the criteria. Well, the managers have to go through the due diligence process of our consultants. For me, it's very important to be a champion of those fund managers that are coming up the ladder.
So thank you, Belinda. And so Ray, what process did the pension fund use and utilize to put the specialized program in place in the first instance or in any instance?
So I think echoing a little bit of Belinda's comments, you know, one of the reason why this program has been successful, it is really the stability of the board. From my position, as I look at all of the activities and tasks that we do each day and each year, it is so much easier to have a group of commissioners that have been in place a long time, that are on the same page on most of the issues, not everything, but are really have a good understanding of what's needed to really focus and push the ball forward. And so having said that, you know, our program, I'm really pleased with our program. It is on a trajectory where it's going to continue to grow. And that growth is really due to the collaboration with the board, discussions at the board level, going through the metrics, going through the numbers. You know, what are we seeing? Who are the funds that are coming, that are being presented to us? What are those ideas? What are those strategies? And as Tom mentioned, it's been a success for us. I mean, it's you know, at this point, 11% plus return. We could not ask for anything more. We are here to provide benefits for our retirees. And while the city is very generous in giving contributions, we as a fund, we need the success from all of our investment managers, and especially our PE folks. And with that, it's sort of the evolution and the discussion with the boards, the discussion with staff, the discussion with Fairview, the discussion with PA. Let's look at sort of these strategies and how we can build on them and keep allocating some money to more and more.
Thank you, Ray. And then Tom, what are some of the attributes that you have observed with respect to the emerging or next generation managers that are coming your way?
Well, our program is structured around some fairly simple guidelines. We invest in funds from 100 million to 500 million. We're looking for people who have diversity in the general partnership level. Other things that the board likes to see are they investing here in California? Are they investing within the city of Los Angeles? Are they doing anything in economically challenged areas of the country? And in terms of the makeup of the general partners, we've been very successful at investing with diverse funds. Generally speaking, most of our general partners are, say, under the age of 50. So it's usually funds that are going to be out there if they're successful in the marketplace for decades to come. And that's one of the advantages of the program for the plan is that, you know, if we get in early and the funds are very successful, we hope that they'll remember us as they get larger and larger and continue to create allocations for us.
So when you think about who you've chosen to produce this program, what were some of the attributes you were looking in the organizations that you chose to basically help build your emerging manager program?
We use two outside investment managers. We use Fairview Capital and Portfolio Advisors. Portfolio Advisors also does some of our other private equity investing as well. It's a process that works on a non-discretionary basis. So once Fairview or Portfolio Advisors has found a fund and done the research and due diligence and want to add it to the portfolio that they're creating for the fund, they come in before the board, and the fund managers don't have to do that. Otherwise, we'd probably have a much smaller portfolio. And Fairview or Portfolio Advisors does a full presentation on the fund to the board, and the board decides whether or not they want to invest in it at that point.
Okay, thank you. And Belinda, let me just come back to you just for a second. And as you are thinking about the program that you've developed and you've watched it develop and you've interacted with the managers and the investment managers that you're working with, what are some of the things that you'd like to be able to add over time? Some of the little comments that you put to the side and said, you know, the next time I'm interested in, I'd like to see, you know, those types of questions that we all should have when you're in positions like that you are fortunate to be in.
Of course, yes. I think with the changing environment, you know, we've now gone through COVID and we're in the middle of COVID, is our goal, I think, is to start to look at different strategies that maybe a public fund has not looked at before, and being a little bit more flexible in terms of the funds that we look at for investing. That would be my goal, because I think that's where you can see some innovation. Again, I have to do that with the support of my board, because we do have a fiduciary responsibility, and we do, in the end, need to make sure that we're protecting the pension of the members. So when we do those things, the discussion is always about risk, who else is doing it in the space, because, you know, we're a public pension. Everything that we do is very much out in the open and is very much scrutinized by the public. So being responsible, but I think also looking at new strategies as we evolve, as our world gets more global. The specialized manager strategies that we're seeing are getting more creative. And I think it's just making sure that we have that conversation about staying open to new ideas and new ways of thinking in terms of raising money.
Thank you, Belinda. And so, Ray, when you think of the individuals that or the companies that you have hired to help build the program, what were some of the attributes that you were looking for from that perspective? Because, of course, if you bring the wrong people on, the results are not normally very good. So you've got to make some important decisions along the way. And I'm just interested, and I think we all are interested in some of the things that went into your thinking and positioning the program as it came from your board from your board.
Sure. So it's been mentioned, we obviously use Fairview and Portfolio Advisors, and some of the key attributes that we have looked at in bringing everyone on is also, you know, while we're looking at for diversity of thoughts and ideas at the GP level, we also need that at our investment advisor level as well. And so it is really Fairview and Portfolio Advisors' ability to bring in and establish a very robust pipeline and willing to really engage and embrace the program. That is very, very key. If we didn't have managers, consultants that did embrace the program, we wouldn't be successful. So your enthusiasm, your focus, your mindset on really trying to help new and emerging managers is key to the success, key to the robust pipeline, and your belief, your strong belief in this area and the ability for it to really produce results. Those are really key for us. We rely so much on you and Portfolio Advisors. We would not be here without you. And so we welcome, and we are so fortunate to have your ability, your foresight to help guide us along in really building this program.
So I cannot help but ask you this question. As you know, over the last several months, this country has gone through quite a bit with respect to inclusion, diversity. All of that has been, it's affected all of us in different ways. And so from the pension fund's perspective and your perspective as a leader of the organization, what are some of the comments that you might have at this point, knowing that you have and you've built, you've built and continue to build a very successful emerging manager and diverse program? What are some of your musings as you've seen what has transpired?
You know, from where I sit, I look across the entire organization, both from the investment managers that we're bringing on, but also my staff that I have here in the fund. And we are really looking at ways that we can attract different backgrounds and people into the fund. I want to bring, build investment team. I want to build an office that is inclusionary and that we bring in folks that are representative of Los Angeles, and we bring in those ideas and thoughts. And that carries also over into the investment side of things. Commissioner Vega mentioned McKinsey's McKinsey study and the KPMG, both of those. I want to say it's probably not anything new from my perspective. It's obviously when you bring in diverse people and different thoughts, you're going to have better results. And that's really the organization and the goal that we've established here and want to continue building on as we move forward.
Thank you, Ray. And Tom, with respect to that Ray's response, and knowing with a long and storied career you have had with the pension fund, and you've seen the building of this program and of course the success of the program, what is your perspective? What's your sort of musing as you look at what you've been able to create and develop?
Well, truthfully, it's a continuation of what this board and many past boards have been doing over the decades. So as Ray noted, we started hiring diverse managers back in 1987. So that was back then pretty unusual. We have diversity reflected throughout our portfolio, our stock and bond managers, our bond managers, real estate managers. It's something that the fund has been doing for a very long time. And so we actually have a lot of experience at it. Even before we started the formal specialized manager program in 2007, we had some diverse funds in the private equity portfolio back then. It was a part of our core portfolio. So those were larger managers. And that was one of the reasons for the creation of the specialized program, is because there are so many managers that size-wise are below the screens of institutional investment managers. So I'm fairly knowledgeable about what other public funds are doing and to some extent foundations and endowments. There are few funds that are willing to fund general partners in the size region that we have done. I mean, there have been also on an exception basis a couple of times where we funded funds that were really below the $100 million minimum we have. The Fairview and portfolio advisors thought they were such promising investments that they came in and the board agreed to the exception. So they were in the $70 to $80 million range. So, but it's just something that the fund has been doing for a very long time. It's not something that we started recently.
So Tom, I have to say to you, since we are looking forward, as you say, to retirement over the next year, sometime over the next year, to thank you for the extraordinary work that you have done in this area and in this arena, and to be able to have been able to set an example for other major pension funds. So thank you very much for everything you've done. And Belinda, I'd like to end our conversation with you, and so that you can talk a little bit about your passion as it relates to diversity, emerging managers, next generation managers, racial diversity, ethnic diversity, more women in the business, as you and I have talked about that as well over time, and just what you have seen during your time on the board, and to see the number of funds that are in your portfolio today, and some of which we will be talking to today. And just how do you feel about all that's happening and all that's actually happening in real time during your tenure?
Sure. Well, of course, the work is not done. If we've seen anything in the last few months, is that we still have a lot of work to do on diversity. We still have a lot of work to do on racial justice, inequality in terms of both the gender gap and racial inequality and institutional racism. And I think for me, I write a lot about this stuff as a venerable partner. I write a lot about diversity on corporate boards, the importance of the two legislations that California has passed on gender diversity and racial diversity in corporate boards, and diversity in terms of the LGBTQ community and veterans on corporate boards. And it's important to me that we see that the studies are there, that innovation and diversity does create revenue for companies. So at the same time, when I'm looking at our fund managers, I'm asking them, what companies are you investing in? What does their diversity look like in terms of their C-suites, their executive officers, their boards, their corporate boards? To me, it's just very important that we continue the work. One of the things that we have learned as I look at our private equity program throughout history is that it takes us, as I said from the beginning, having metrics and measuring ourselves and being tough on ourselves in terms of whether we're meeting those metrics. And if we're not, why not? And I think it's an exciting time. I think for me, the fact that we're talking about these issues means that there's a lot of excitement, because we get to now present the arguments of why diversity matters on corporate boards, why diversity matters on pension boards. I have the ability to be able to make decisions along with my board members that make a real difference, I think, in terms of how we look at Wall Street and in terms of how we look at investing. And I think as we look at the smaller funds, one of the questions that was asked, I think, in the Q&A is, how do we get the smaller funds investing? We're a pension board, so we have responsibilities to our members. But as I said before, it's having that conversation with the pipeline about teaching them what it would look like to become somebody who does get a public investment. So it's to me, it's a passion. I'm going to continue, even after I'm done serving on the board, I'm going to continue talking about these issues, because I do think that it does add a difference to the bottom line, not just because it's a good thing to do, but because it's really adding value and it's increasing the pension of my of my members, which is what I'm responsible for.
So thank you very much, Belinda. And Belinda, Ray and Tom, thank you all for the leadership that you have provided. Thank you for providing an opportunity for us to have this program today. And thank you for the work, the successful work that you're doing. And thank you for your relationship with Fairview Capital.
Thank you, Joanne. Joanne, may I just make one other comment? I just want, because I think I saw a question come up through the chat. I mentioned a little bit about our trajectory, where we're going with this program. The board allocated $150 million to this program in 2016. And then in 2018, they allocated another $200 million. And then fairly recently, in August, they allocated another $300 million. And with the work that Fairview and Portfolio Advisors is doing in bringing in these funds, once those allocations are up, I'll be recommending to the board, and I'm sure the board will be approving another 300 plus allocation in 2021, 2022. It's up to you, Fairview.
Well, Fairview,
No pressure.
Fairview very much appreciates it, and we certainly will be there when the next opportunity presents. Thank you very much. And Cindy, I'm going to turn it back over to you.
Great. Thank you for that. That was such an insightful panel. I certainly learned about some historical stats I didn't know before. So it is my pleasure now to introduce to you our next panel. This panel consists of specialized managers that are currently part of LAFPP's Specialized Manager Program. And they're here to share with you their personal story or journey, if you will, on building an enduring franchise. So may I have the following individuals join me on screen? May I have Gus, Richard, Takashi, TJ, Miriam, and Evelise join me on screen. Great. Okay. So to start this panel, I think I'll have the speakers do their own intro and also just weave into part of that introduction, you know, to share with the audience what was the driving force behind your decision to start your own private equity or venture capital franchise. And then if you could tell us a little bit about the investment strategy that your firm is currently pursuing. So I will start with Gus, and this is in alphabetical order by last names.
Good morning, everyone, and thank you to the pension, to Fairview, to Portfolio Advisors for putting together this event. My name is Gustavo Alvarelli. I'm one of the co-founders and managing directors of Sunstone Partners. We are a growth equity, growth buyout firm formed 5 years ago. We've raised 2 funds, $300 million for Fund 1, $475 for Fund 2. We focus on buyouts of first institutional capital opportunities. So these are companies that were, kind of bootstrapped and started the old-fashioned way, kind of rubbing credit cards together, taking out a second mortgage on the house, raising money from friends, family. And they had to be profitable by necessity because, when you don't have a rich sugar daddy VC funding losses, you have no other way to stay in business than to be profitable. So whether we can get into this later in the presentation, but whether, because of opportunities that didn't exist or because of a determined effort, these are founders that had to go it alone. And as a result, you see a disproportionate number of women and minorities in our portfolio as founders, and we work with them to, cash out, provide some partial liquidity, either as a minority sometimes or usually as a majority investor, where they roll a significant portion alongside us, and we try and build the company to get to the next stage of its growth. We set out to do this. My partners and I, Arnique Multani and Mike Biggie and I, set out to build this firm because we thought there was an opportunity to do things a little different in private equity, especially. If you look at our firm, our CFO is female. The head of our business development is female, born in Peru. The head of our post-investment operations, born in India, also female. And so, we practice what we preach, and it's led to strong returns. And we don't do it because, LPs, the reality is the number of LPs that care about this, unfortunately, is a very small number. As probably a lot of people in the audience know, a lot of LPs aren't asking these questions. It's increased, and you're seeing more of that in the last few years, but there's not nearly enough pension funds like this one that really make it a priority, or like Fairview or like Portfolio Advisors that go out and try and find managers that think about these things. And so at the end of the day, we have a fiduciary duty to our investors to really just focus on performance. And we've been fortunate to have strong performance, both before we spun out in 2015 and post starting Sunstone. But at the end of the day, we think the two are very much in sync and look forward to continuing our strategy, both as we build Sunstone and as we target founders and CEOs to work with. Thank you very much.
Great. Thank you, Gus. And I'll ask Rich Kirby from Equal Ventures the same question. pass it on.
Thanks. Yeah, so Richard Kirby here, one of the two founding general partners at Equal Ventures. We're a seed stage focused fund based in New York, investing across the United States. Our first fund's a $55 million fund where we are a generalist fund, but we focus on what we call legacy markets. And so we deem those as categories that have not yet become tech enabled. And a couple examples of categories that fit the bill for us are energy, logistics, supply chain, childcare, retail, et cetera. And as we think about that, that has enabled us to kind of look at a broader set of founders that think generally get ignored, which is I think a lot of fun for us. As we continue and answer, I guess, your second question there, Cindy, around the driving force behind starting Equal is, sorry about the noise there, is that someone's at the door apparently. But yeah, for me, I think it was one of three things. One, a concept of trying to go earlier and earlier stage. And so started off my career at a firm called IVP, pretty much as late as you can get in the venture landscape, and then moved down to Venrock and now focusing on seed stage. So one big driving force for me personally was going earlier stage. I think the second was, my partner and myself really feeling that we were prepared and ready to go launch our own firm. And I think the third piece for us is really wanting to kind of create a firm where you could set your own culture rather than having to, try and change the culture of an organization that's been around for 50 or 60 or plus years or so.
That's great. Thank you for that. And Takashi, you're next.
Good afternoon, good morning. My name is Takashi Moriuchi. I am one of the co-founders of Estancia Capital Management. Estancia Capital Management is located in Scottsdale, Arizona and Philadelphia. We have raised one fund and we're in the process of raising our second right now. Our first fund was $180 million and our second will probably be somewhere around 200 or north of 200, depending on fundraising during COVID is kind of challenging. Our focus is around a very specific niche within financial services. So we are a specialist. We focus on three sub-verticals within financial services. Key characteristic of those companies that they're balance sheet light. And the three verticals we focus on are institutional asset management, which are, in our view, manufacturing companies, wealth management companies, which are the distributor or consumer of the manufacturing, and then typically tech-enabled businesses that support asset management, capital markets businesses, broadly speaking. So we think about an ecosystem in which we're investing in. And we'll talk about this in a little bit later about some of the other things that we do or think about. But for my partners and I, Mike Mendez and I co-founded this business. There was really three things that I think brought us together and why we launched Estancia. One was we saw an opportunity. We focus on the lower end of the market. A lot of the private equity firms that focused on this part of the market have been very successful and have moved up market. So that's TA, Hellman, Freeman, Lightyear, my old firm, Level Minnick Partners. So we identified a real opportunity because it is now, we are the only firm focused at the lower end with companies that have anywhere from 10 to 15, 20 million of EBITDA. And as a result of that, there's also some demographics at play and some other catalysts that create a bunch of opportunities. So we went out and launched our business to take advantage of that. So that was one, just the overall market opportunity. Two, we're very motivated guys and gals. We had we've done this for other people and we wanted to do it for ourselves. And as Richard said, we also, the third thing was we wanted to create our own culture where we could pay it forward and bring a firm together that doesn't look like a lot of the other firms. The fact that we can, we're all sitting here today and there's a group of us, but I think we can all name the companies that have come before us that the Clear Lakes of the world, we are all aspiring to look like that and achieve that success. So those are the three main drivers for us, Cindy. So thank you for inviting us here today to talk about our story.
Yeah, no, thank you for that. And I think we'll hear that reoccurring theme as we follow up with TJ on the same question.
Well, thank you, Cynthia, Fairview, and LAFPP for having me today. And it's great to see a number of the other panelists here, many of which we've known and gotten to work with now for a number of years. I'm TJ Nahigi, and I'm one of the co-founders and managing partners at Base 10, we're an early stage venture firm. We focus broadly on this theme of automation for the real economy. So we tend to focus on large, old school industries, partner with entrepreneurs and companies at the early stage that are using data, intelligent software, new services to help automate and improve those industries. We are investing out of our second fund. Our first fund was $137 million. Our second fund's a $250 million fund. And the reason we started Base 10 was we saw, I would say, a shift in the venture landscape, which is creating significantly more companies that are getting to real venture scale. And these are oftentimes happening in places that are outside of Silicon Valley and in industries that have traditionally not been touched by Silicon Valley. And we didn't see any firms that were set up to focus on that. And so we've built Base 10 in a way to pursue those opportunities. We're still early in our journey, but we've tended to focus on a very specific process, which I think I'll talk through later, very trend focused, very much like a hedge fund, but using an outbound process, much like growth equity or private equity funds, but still investing like a venture fund that we think is well suited for this environment. I think as COVID has hit, a number of firms have started to change how they think about investing. And we were lucky that we got started on that 4 or 5 years ago with that process. So anyways, excited to be here today and thank you for having me.
Great, thank you, TJ. And I think the point that you just made is this, the way that you could think about processes a little different from your predecessor funds. I think that's what we love about diverse and specialized managers. Anyway, without taking too much airtime, I'll let Miriam tell us, her inception story and her journey thus far.
So Ulu Ventures is a seed stage enterprise IT focused fund located in Northern California, in Palo Alto. We have been in business for about 12 years, and I think our two areas of interest and why we started the firm were both being surprised at the lack of diversity in venture capital funds at that time. One of the things that went unspoken about Google, where I was before I started Ulu Ventures, was that the initial diversity of our teams, I think, absolutely contributed to the outsized success of the company. And yet it was hardly ever remarked on. And I saw it from the inside, where almost every functional team in the entire company had a male-female lead, and almost about a third of the senior management were people of color or immigrants at that time. And when we would see some of our engineers go back to their home countries like India or Mexico in order to try to access capital because they weren't able to get it on Sand Hill Road at that time. So we saw a real opportunity in terms of what was happening in the tech companies wasn't happening in venture, and we wanted to be in front of that train. And so that was really one of the theses. The other one was that venture, like other asset classes, would have to become more data-driven as opposed to just relationship-driven, and that there were better ways of making investment decisions related to individual companies and at the portfolio construction level. And we think that our large portfolio construction is really an integral part of the financial performance of our fund. We also think that it's going to enable us to build a scalable seed firm over the long term, because we want to stay at this level. Typically, managers want to increase their asset bases, and the easiest way to do that is to go up market to become a firm, a later stage firm. But because we're making an impact at a national level in terms of increasing diversity in venture capital, we want to stick with our mission and demonstrate that larger portfolios of such diverse talent are going to provide fund over fund performance that we think is going to enhance the sector as a whole, is going to impact public companies that are being created by diverse teams and that employ now a third of non-US farm workers. And so they have outsized impact culturally in our nation, and we want to make sure that at that stage, our nation is reflected in terms of who has assets, who gets access to capital and the assets under management of organizations like Los Angeles Fire and Police Pension.
Mhm. Great, thank you for that, Miriam. And then Evelise. You could
Yes,
join
hi,
the screen.
Cynthia.
Hi.
So, thank you for having me, and to Joanne, to the rest of the Fairview team. I couldn't be more excited to partner with you guys and with LA Fire and Police. So I'm Evelise Rodriguez-Simon, and I'm the managing partner and one of the founders of Avanti Capital Partners. We are a woman and Latina-owned private credit fund focused on the lower middle market. So we launched in 2009. Our first fund was $218 million. We raised our second fund in 2015, and that was $250 million. And we just raised our third fund, where LA Fire and Police became an investor, and that fund is $360 million. And so we invest in private credit, lower middle market. We focus on small businesses and creating jobs. And the reason we started our firm, we had a couple of reasons. First, we saw an opportunity to focus and serve the lower middle market in a different way and partner with private equity sponsors, particularly women private equity partners. That was a growing number of women in private equity, and we have a very large ecosystem of women. We also just wanted to create our own culture and focus on diversity and inclusion without having to make any apologies or excuses or reasons why. And so we had full authority to do that because we own the firm. And it's resulted in not only really, really great returns, but in a firm that we love, and with people that we appreciate, and doing work that we really enjoy. So thanks for having me, Cynthia.
Oh, of course. And what would you say the greatest asset your team possess? You already touched upon your team members.
Yeah, it's most certainly our team, right? Our team is really smart. They're highly diverse. I think 12 of the 15 of us are women, minorities, or both. But we're not only diverse in terms culturally, we come from different backgrounds. We look for non-traditional backgrounds, and we celebrate differences, and we appreciate everybody's contribution. And so I think that the respect that we have for each other and the common goal is really our best attributes, our best asset.
Great. Now I'll turn the same question to TJ as well in terms of the greatest asset you and your team possess. I know Base 10 is doing some other projects around the inclusion,
Yes.
diversity efforts. But if you could touch upon the greatest asset and then perhaps talk a little bit about what Base 10 is doing.
Sure. So I would say at different times, there's different assets that are important, but it all sort of goes back to being entrepreneurs. So both my co-founder, Ade, and I were entrepreneurs before starting Base 10. And I think the grit that comes along with being entrepreneurs has been probably the thing that has made us achieve some level of early success so far. I want to say we're still very, very early in our progress, but particularly from getting a firm started, that is by far the most valuable, I would say, characteristic. I think what we've done with that is we've drawn on a very diverse set of backgrounds to set up a process that we think is unique and better suited for the current and go forward environment. And between Ada and I, both of us entrepreneurs and investors historically, I actually got to meet him because he was an investor in my business, even though he's a serial entrepreneur, but he accidentally became an investor. And along with the team we've assembled, have drawn on sort of the best of breed that we've learned both in the hedge fund world, in the growth equity and private equity world, and in the venture world. And we do that very much with software and data driven platform to keep us honest to this process and to give us scale with a relatively small team. And so I would say that it's sort of a long way of saying, I think that today is our greatest asset, but we wouldn't have gotten there if we weren't entrepreneurs, and it really draws on that diverse set of backgrounds and experience. And then regarding diversity and inclusion, I would say we're still, Cynthia, early in this process, but are making some meaningful progress. I think it's something that we've thought about from the beginning of our firm. It's not something that we were necessarily set up to focus on at the beginning. We really wanted to be investing in the best companies and entrepreneurs, regardless of the industry that they were in or the location that they were in. It just so happened that when you use the data-driven approach, you actually happen to back a much more diverse set of entrepreneurs, where about 50% are minorities, and a high subset of that is underrepresented minorities. From an entrepreneurial perspective, as we think about the firm and what we want to build long term, I think what I would say is we've really looked up to a firm called Generation, which is Al Gore's fund that was started in the mid 2000s, focused on sustainability. There were a number of other firms started with a focus on clean tech and green tech, and for the most part, they've actually not done very well as a subset and focus, but Generation has. And the reason is that they just focused on investing in the best companies with a goal of making them more sustainable and really focusing on that. And I think as we start to think through how we can make a real impact on diversity and inclusion, we have really benefited from learning how Generation was set up and built, and thinking about maybe there is something that we could do in a similar manner. We're lucky that one of the founders and CIO of Generation has been a personal investor in Base 10 from the beginning and has been a mentor to us even prior to starting Base 10. And I think there's frankly a lot more that we plan on doing. I think we just want to be really thoughtful about how we do it, given how important the topic is. So that's probably as much as I could share today, but
Thank you for that. And I love that you touched upon grit and just being entrepreneurs, because clearly all of you are entrepreneurs in this, in creating your own franchise. And so that leads me to my second set of questions, really about, how long did it take for you from your initial thought to actually launching a firm? And you can answer these in just numbers, or maybe you have a more longer answer, I don't know. But I'll let Miriam start first. And then also, in terms of when you were thinking about launching a new firm, who did you talk to? Was it a prior set of LPs, mentors, or anyone in your network? And also a good piece of advice they may have given you at that point.
So when we decided to institutionalize Ulu Ventures, because we had been a family office, we did go and talk to a number of mentors, and we were fortunate in that we were part of the Kauffman Fellows program, each of us in our respective classes. And so we had mentors that we had made through that organization. And so Susan Mason was one of my mentors. And so I feel very fortunate that I had a very senior, very experienced woman investor in my corner. And she was one of the first people that we talked to. And she gave us, great advice on our deck. She gave us great advice about things like lines of credit for running a venture firm and making it easier to do this. She introduced us to Joanne Price, so we'll forever be grateful to her as well for that, because I didn't realize at that time that essentially Joanne, I think, is one of the mothers of this industry of diversity investing. And so we just happened to have a woman who knew another woman and who made an introduction to a next generation of women in the space. So grateful to Susan and also Joanne. We had a mentor in Dave Strom, who was the founding partner at Greylock Menlo Park. And he had co-taught a course with my partner in the engineering school at Stanford on startup boards. And so he actually said, if you and Miriam start a fund, I'll write the first check. And so that was really one of those kinds of moments where somebody really shows that they believe in you. And given his success in the industry, he's got something like 12 or 14 IPOs to his credit. It was like, okay, well, this is a good indication that, good investors would support us. And then, we've had mentors like Fern Mandelbaum, who teaches a lot about diversity and is with the Emerson Collective team in Palo Alto, as well as I want to remark on Jose Feliciano and Mina Pacheco Nazemi, who have both been tremendous supporters, have introduced us to LPs, have given us advice. Jose at Clear Lake has invited us to his annual meeting, and he's like taking time at his annual meeting to introduce me to his LPs. So those kinds of things have been tremendously helpful in terms of raising a fund and just having role models like them. To be honest, there were many years when I found venture capital to be one of the most inhospitable industries in which I'd worked. And I'd worked in pretty much male-dominated industries my entire career. So that was saying something. And finding these kinds of mentors and support to navigate the environment of fundraising has been really critical. And there are definitely studies by Harvard Business School that indicate if you're a woman, you're a person of color, you need to actually find these kind of people that have navigated and succeeded in these kinds of environments to support your efforts, because that is critical to both the social support that you need and to the navigational success within an environment. And then in terms of how long it took from the beginning to the end of fundraising, I wasn't surprised, because as part of the Kauffman Fellows, there's over 100 first-time funds that have been launched. And so I knew that the average time was something like 18 to 24 months to really raise and close a first fund. And we were right about 18 months in fund one.
And I want to give the audience a good cross-section of the different stages. So Miriam Ulu clearly is a seed early stage venture, and TJ also early stage. I want to give the floor to both Takashi and Gus to talk more from a growth equity and also buyout mindset. Same question regarding initial thought to actually launching the firm. I met Takashi at the New York NYSTER's Emerging Manager Conference so many years ago on those snowy Valentine's Day weekends that they like to host those. And so Takashi, how long did it take for you from initial thought to launching the firm? And any advice that you got during that period?
Sure, and I've been actually looking at some of the questions too, and I know there's varying sizes of firms that are in the audience. When I first started thinking about this, it was actually years ago when I was in the bullpen working for a firm called Lovell Minnick Partners, and late nights. And one of my other partners at Estancia was also my friend and analyst beside me. So talk about that. That's like 15 years prior to actually launching Estancia. But when I met Mike Mendez, who is the other co-founder with me, we started talking, and it probably took us about 6 6 months to kind of land on what we both collectively thought the strategy should be. And then from there, it took us another 6 months to get the material together and go out. So I'd say from the time we actually launched and went out, it did take another 24 months. So in all, if you think about it from the very beginning of kind of conception to having a closing, and then a final closing was about 3 years. So it is a long time. I think this goes back to really knowing yourself. And, as I think as TJ said, you do have to be an entrepreneur, and you have to believe that you're going to be successful. You have to be comfortable with people telling you no all the time when you put your heart and soul into everything, and not letting that bother you, or at least not letting people know that bothers you. It might bother you when you're sitting, at home in the dark of your room or office, but it does take some time. So I think everyone that is thinking about doing this for the first time, I definitely would say, look, think about how long you personally can stand without making, whatever it is you need to make to take care of your family. And that, and then double that, because that's typically what ends up happening. So that was for us, and how long it took.
Great, thank you. And I think it's helpful for the audience, because I feel like in COVID period, we're almost working in a vacuum and, in these silos, and we don't really have the opportunity to test out. Does that sound right? Does, 18 months sound right? Is it 3 years? Is it 2 years? So thank you for that and your honesty.
And just real quick, we're raising our next fund right now, and honestly, that has COVID has put a pause on things. So if we have time, I can come back to what we're seeing right now. But first fund took a while.
Yeah. So I'll jump over to Gus and then Richard to ask the same question. Want to give Richard a heads up. You're next.
Yeah, he's in the bullpen. So, every situation of these entrepreneurial firms on this panel is a little different. For us, we had the good fortune of actually working together for several years as partners at a firm called Trident Capital. We were effectively the growth equity, growth buyout arm of Trident Capital. So, we had been thinking about spinning out, frankly, for a while for a variety of reasons. And, I think part of it too, there's a certain desire, these themes have been touched on, to be entrepreneurial, to start your own thing, to be able to put your own culture front and center of ways of doing things. And we saw a real market opportunity targeting the type of businesses that we focus on. Again, just kind of tech-enabled services companies where it's the first institutional capital. So that was really kind of our focus. We were fortunate enough through a couple, different groups, whether it's MLT, Hispanic Heritage Foundation, Toego, to meet some mentors and folks that could guide us. And some of the folks have been mentioned on this call. Kind of those that kind of came before us, and frankly, without some of them, we probably wouldn't be here. The success that some of these firms have had, like Clear Lake or like a Genstar, those are firms that were kind enough to open their Rolodex and be helpful along the way. And we had short conversations in the early days of, hey, this is what we're thinking. But then really it comes down to LPs willing to take a chance on early managers. Certainly everybody's got their own story. My wife was pregnant, 6 months pregnant with our first child, where I said, hey, good news. So we're going to go to zero and we're going to start our own thing. And she kind of looked at me and just left the room without saying anything. And then came back and said, okay, we're going to do this, but, sounds good. So, I think she's not on this call and she's not in the other room, I promise. But, honestly, without strong family support and partner support, you really can't do this. I mean, I have so much respect for anyone, especially the folks on this call that have been able to do it and be successful, but especially for those single GP managers. It's just, I feel like I can barely do this job, and I've got two equal partners that are rowing just as hard in the same direction as us. And, just getting to the heart of the question, listen, we have been talking about it forever, from first meeting with an LP, kind of till final close. In our case was 11 months, but that's a little bit cheating. You know, there's really kind of probably a 6-month plus period there where we were, you know, basically meeting every week, a couple hours specific to kind of prep. So if I add that time, it really is more along the kind of 18-month point. And I'll just conclude with the final advice that, you know, it's going to be hard. I mean, you know, this is a great profession. There's wonderful opportunities. You know, folks on this call have, you know, all of the abilities to be successful. But, you know, it's going to be tough. And there's definitely going to be some dark days when you're taking the red eye and you do a bunch of meetings, and you know, by the 4th meeting, you don't even know kind of what you're saying anymore, and you're trying not to fall asleep, and you're on your 5th cup of coffee. And then you dig down and you kind of remember, like, hey, listen, my mom came as a refugee from Cuba when she was 10 years old with no money with her family. You know, this isn't so bad. You know, like I can suck it up. You know, I can get through this. And, you know, fortunately we came on the other side and you know, we're successful in fundraising, and I've been fortunate enough to do well. But, you know, I think kind of having that perspective of, hey, you know, certainly not just people I know have, you know, gone through much worse, and but my own family. So I think just, you know, keep your eye on the prize, keep going, know that it's going to take a while. Doesn't mean you're not, it doesn't mean you're failing. Just the opposite, just part of the process. It's almost kind of like, you know, I played sports in college. You kind of almost have to view it as hazing. You know, I think one of the panelists mentioned, you know, how often you hear no. It was very humbling, you know, how often you're told, well, yeah, you know, come back to me for fund 4. Like, oh, great. So, you know, it takes time. And then the last thing I'll say, I don't know if I'll have a chance to say this later, but if you can, find someone that can help you warehouse your first deal, or if you're an earlier stage venture fund, maybe a couple deals. That, at least for us, was instrumental in helping us, you know, convince folks that, hey, even though this is the strategy we're telling you, even though it's exactly the same strategy we've been doing for like a decade together previously, we're not going to like go off the reservation once the inmates have taken over the asylum, and we're going to go invest in something totally different. We're just going to stick to our knitting and do the same thing. And there was this like real fear, like the LPs are like, wow, what are you going to do now that you're under the Sunstone umbrella? It's like, we're going to do the same thing, I promise. And so we were fortunate in that we had an LP, you know, warehouse our first deal, and that really helped a lot. It solved the blind pool issue. It gives people comfort, like, oh, okay. And just as you're telling the story, you can point to, hey, here's how I sourced it. Here's what we're doing post-investment, you know, et cetera, et cetera. So anyway, just wanted to throw that in there in case we don't get a chance to talk about that later.
Great, thank you.
Yeah, on our end, Equal Venture side, yeah, I'd say the like start of like hardcore fundraising until, you know, final close, I would say that was like a true 18 months. And then I would add an additional 6 months prior of like trying to really triangulate on your story, your strategy, and make it, you know, concise and cohesive to the LP, which I think we were still pretty bad at doing. And so even that 6 months of planning didn't even cut down our 18 months of fundraising time. And so I would echo a lot of what Gustavo just said around just like the challenge of you know, raising a first fund. I think, you know, Cindy had mentioned that one of the following questions around, you know, what were the challenges around raising a fund? And I don't know what wasn't challenging, actually, because it was all really, really hard. From one, you know, not knowing which LPs to target, because LPs generally don't market themselves or make themselves widely available like this session. So thanks again to Fairview for doing this. Secondly, you have no idea oftentimes where you are in the process for that LP. And so it could be 10 meetings equals, you know, 2 meetings for another LP, but you aren't quite aware of where you are in that scenario. And it's all really, really challenging. And I think, at least for myself and my partner, Rick, it was our first time being entrepreneurs. And so I think we weren't really that great at telling our story, to be honest with you, at the very beginning. And so we were fortunate to have, you know, LPs, including Fairview, who were okay hearing a rough pitch in the beginning, allowing us to kind of reframe ourselves and come back with something more compelling each time. And so on the kind of mentor side, you mentioned, Cynthia, I think, yes, for sure. Previous bosses were great mentors throughout this process. Other GPs who we were fortunate to get as investors in the fund, as well as LPs. One of it obviously being Fairview. I was fortunate that I knew Larry prior to launching Equal, so it was great to get Larry's many decades of wisdom that I wasn't privy to, as well as I think Akar might have been the very first formal pitch we ever had, and so it was great to get really early exposure to a group that you felt safe with, that wouldn't, dismiss you for not being quite crisp enough yet to kind of be ready. And then we had a similar story to what Miriam said as well, where we had an LP, Low Tony at Plexo Capital, who basically said, hey, whenever you're ready to leave, let me know, because we've got money for you. And so getting that vote of confidence early on makes you think, oh, actually, maybe I am ready to go do this. Because it's really, really scary to, do what Gustavo did and say, hey, wife that's pregnant for the 6-month-old child on the way, let's go not have income. Because I was not in a pregnancy scenario, but my wife was a resident in New York City. So not sure if folks in the medical field, but residents don't make very much money. And obviously New York's very, very expensive. And so all those things make it really challenging. But if you can get friends, family, other peers supporting you, it makes it a lot easier, even though it's a long and hard journey.
What Richard doesn't know is that we've been tracking his career since the days of IVP. So I've met him there at annual meeting and at Venrock. And so when he was ready to launch Equal Ventures, and this is what we do for a lot of our emerging managers and specialized managers, is that they come to Fairview and we're the first or second, third call, and we hear that rough draft. And we critique, and we're all adults, so can handle those criticism, in a good way. So, as part of that process, I think the retelling of the story and the refining was important. So, Richard, can you tell the audience kind of how did you shape your track record and frame your experience more effectively to convey the strategy to LPs to raise that first fund?
Yeah, I think we changed a lot of different things. I think one is, when you're starting something new, you tend to look at what is the status quo and what should change. And when you look at it, you're like, all right, 18 things should change. And so you think you need to go solve all those 18 things. In actuality, you don't need to go do that. And so I think it was just, you were trying to do too much all at once, I think, at first. And so I think that was a piece for us, because we saw many challenges with early stage venture, but you don't have to solve all the world's problems at once effectively. And I think the second piece was, we were doing things that we tell founders not to do to ourselves as well, which was, hey, qualify LPs. We weren't doing that. So there'd be, funds that are LPs that only invest in $1 billion plus funds, and we're a $700 million fund. And so we were wasting our time on that dimension. And then I think the other piece that, that helped us, I guess, in our favor is that we had track records that we could attribute to ourselves. And so we were fortunate that, one, my partner Rick had a fully attributable track record from his previous firm, Lightbank. And then two, my boss at Venrock, who I did my deals with, was an investor in the fund and a really supportive, GP and reference. And so I think that really helped. That wasn't a change in the story, but I think that helped get folks across the finish line. I know that the track record question is always this like mysterious thing, like, did you do the deal? Did you not do the deal? And I think the last kicker on the track record piece was that we had the ability to have any LP that wanted to go talk to the CEOs of those companies who did all the work. And so I imagine everyone here on the panel at some point was the non-important partner at some firm who was slaving through the night to get things done about the founder that they love. And obviously the GP comes, sweeps in, says, okay, this is a great deal. I'm taking this over myself. And so I think we all have those same stories, but fortunately we have those CEOs that we supported and believed in early on who could vouch for everyone on the panel, fortunately. And so we had that as well, which I think is always can be a scary and challenging part of the reference piece, because you don't know what happens. And so that was helpful for us as well. And then I think the last piece was just that, I guess reinforcement of like sticking to like what you're good at, right? And so I think Gustavo mentioned, sticking to his playbook. There are things that I'm really good at, I think, that my partner's not very good at, and vice versa. And so I think the combination of those two things and like voicing that helped us honestly have more confidence in our own pitch, and getting feedback from folks like Fairview and others was helpful in that process. And so fortunately it worked out. I think no one wants, I should say, to have an 18-month fundraising process and have no income for that long or longer. But fortunately it's paid off to date so far.
Great, well, thank you for that. And Evelise, you and your team just successfully finished raising Fund 3, so congratulations. Tell us a little bit about that. I know you guys started fundraising, right in around COVID, maybe a little before. So any strategies that you may be able to share with the audience? Clearly, most of them won't have a build base like that you had. So any strategy would be helpful.
Yeah, and just maybe a little message of hope for the audience, because
Yeah.
right, because it took us also 2 years to raise our fund, and I was the one pregnant with twins on bed rest. So it was very complicated. My partners actually had to come to my bedside, and that's where we would make our calls. So it took us 2 years, and it was very difficult, right? It felt like you went 2 steps forward and 3 steps back, and just weren't making progress. And it took a lot of champions, right? It took a lot of advocates and champions and people who believed in us. And so that's what I would certainly encourage the audience, is to find those people, the people you worked with, you worked for, to be your advocates and your champions, because that's really what it takes. And also an offer of help, right? If there are people out there that have similar strategies to me or think that I could be helpful, please reach out to me, because there are so many that help me. I really feel like it's our responsibility to help others, particularly if you're women. Yes, I have a bias. But so our second fund took 6 months to raise, and it was primarily our existing investors and just a handful of new investors. And our third fund, we sort of launched in March, but kind of pulled back when COVID hit, and then sort of relaunched in July. And so maybe it took us a really dedicated time, about 6 months. And so it gets easier, right? It's not going to be 2 years each time. And you're going to have a track record, and you're going to have relationships with your investors. And so it does become easier as you build a more sustainable franchise and business. And so it's not all awful. And then it becomes kind of exciting. We were targeting raising 300 million, and we've raised 360. Right? So we are way oversubscribed. And so again, just a message of hope for those out there, that you could raise it. And then once you raise number 2 and 3, it becomes a lot easier and a lot better. We were very consistent with our strategy. And I think that that's one thing that helped us. We haven't changed what we do in 11 years. So I think really staying very consistent, keeping our team together. I mean, the other question, your question, Cynthia, about how long did it take you to sort of build your firm? I'd say it took us 2 years to launch the firm, but it's sort of taken us decades to build this firm. All of our past experiences, and then even building this firm, the first 5 years was really hard, right? We didn't know how to recruit people, how to retain people. We went through a partnership issue. I mean, it was a lot of work and a lot of ups and downs. And so it just takes a lot of dedication. What else?
What are some traits that you're looking for in terms of, as you build your next generation of investment professionals in your organization? What are some of those qualities? And clearly they have to admire and want to be part of your firm's culture. But what are some other things?
So we say we're looking for 2 different things. We're looking for just natural intelligence and curiosity and an ability to do this work really well. And then we're looking for cultural fit. People who really support our mission and believe in what we do. And one of my favorite quotes is, a small team kind of committed to a cause bigger than yourself can accomplish anything. And I feel like that's really what our team is. Our team is, we're small, but we work together very well. Somebody mentioned, some people are good at one thing, others are good at other things, and just respecting what everybody's very good at and recognizing that and trying to get the best potential out of everybody. And so we're looking for just smart, capable, but really committed and passionate people.
Well, thank you for that. I'll leave this next question open. So if we could bring up all of the panelists on the screen in the grid form, that would be great. And it's obvious, I think, that it's difficult to raise capital as an emerging or diverse manager. I guess one way to frame this issue is, why do you think it's so difficult? And then I'll start there. So feel free to raise your hand if you want to go ahead, and perhaps in the answering of it, other things may jump out at us. Yeah, Miriam.
So
And
I think some of the reasons that it's so difficult to raise a fund really are holdovers from prior history of structural racism within asset management. And some of the things that people should be aware of is just that only 1.3% of the world's assets are invested in firms that are led by women and people of color. And that got to be that way in many ways because there is a whole system of race neutral criteria that tend to mean that money doesn't go to people of color or women. And typically those might be things like, oh, we don't invest in funds under $300 million. We want to see managers with a lot of skin in the game. There's a lot of these kinds of things that have really excluded folks that don't have either the economic means to put in the same kinds of GP contributions that others do. And I think that makes a big difference in terms of the LP base that you can aspire to. And then those LP bases and the lack of institutional base in funds make them have less longevity, right? And so like only 10% of funds get to be a fund 4. And so you have to build this really strong foundation, but the smaller a firm you are, the more difficult that is. And just in terms of being an attorney, one of the things that I realized when I was in law school was how we define discrimination in the United States makes it so that you can almost never find it. And that is that discrimination is defined as when race or a protected characteristic is the sole basis for denying someone a resource, a job, etc. And there are often many such reasons. Now, the fact that they may have started as a way to exclude people consciously isn't part of the equation, if you will, of whether it still continues to actually affect a racially biased or other form of biased impact. And for example, in Palo Alto, there was a park that was funded solely by the town of Palo Alto. And in the 1960s, they said it was only open to Palo Alto residents. Now, that was the same as saying at that time, it's mostly open to white people. And to this day, it had still been that way. And I think ultimately, they decided to change that because it's still the legacy of structural racism that is preventing access to this resource. And I think the same things actually kind of apply with financial services.
Mm-hmm. I agree. Kashi?
I would agree 100%. I think that there is institutional bias, and the pension funds have very big responsibilities, and that's not lost on us, right? They're responsible, and it's easier to invest in an established fund that is on Fund 8 than it is to invest in Fund 1. I think what it's going to take are board members that understand the value of diversity, and that we don't increase risk, but we could actually increase alpha, right? We could actually add a return. So when I was listening to Belinda, for instance, I thought, I wish we could clone her and put her across the country, because she understands that we're talking about returns, that it will improve returns, right? We're not saying this is a social necessity, even though it is. It actually, the pension funds have fiscal responsibilities, and this will play into it. And so I think until that happens, it's going to continue to be very difficult. I've been working for minority-owned funds for 16 years, and it is no easier now than it was 16 years ago.
Yeah, and I know you're doing a lot to promote diversity, especially for women in the space. So Thank you for all the hard work there.
Yeah, and I think it's sort of our responsibility, you know, if we're sitting in the room, we're the only one in the room that looks like us, then we have to speak up for the rest of us that aren't in the room. And so we take that responsibility really, really seriously. We have a diversity internship. We want to bring more women and people of color into the industry so that they can build their own businesses. And so that 1.3% number could turn into something that is not so awful.
Right, right.
We really appreciate all the work that you guys do at Fairview. I mean, it's really, really important work, supporting us, leading this effort. And so thank you for that.
Thank you. I'm going to go to Takashi and then I think, and then close with Richard's comment.
You know, so unfortunately, it is a numbers game. And that's the issue that we all face. And so when you think about when we were being funded and we did get a champion, and I think that's probably every one of us has a champion that's on this board. And we were fortunate that Mina, and then much like Fairview, got behind us early. And as a result of that, allowed us to then be very focused on where we went. But when Mina decided to get behind us, we were, I think, one of 8 new funds that were funded in a year, and there were 600 funds that were reviewed by them, which at the time it was CFIG. So it's you have to have that hook or something that's different. And for a lot of firms that have been successful, and I think you're seeing some of this across the board, is do you have an anchor, or do you have someone, a track record or some deals that you've done that you can bring to the table that make you stand out from everybody else? And I think that's one of the things that you need to think, you know, for the folks that are on this call, if you can think about how do you best position yourself and not make those mistakes of calling on that $1 billion, the LPs that only invest in $1 billion that eat up critical amounts of time that you don't have a lot of. That's very important. So talking with groups like Fairview, talking, you know, with the emerging manager, the gatekeepers that have the emerging manager programs, and thank God for LA Fire and Police. These are the folks you got to go after right away, because if you don't get them on board, it's very hard to get critical mass unless you have some other anchor or someone else behind you.
Thank you for that.
Yeah, I just want to kind of double down on Miriam's points. I think the first one is, you know, LPs look at GPs that they've had in the past and said that, okay, these GPs have done really, really well, and they've traditionally been, you know, white male GPs. And that's not because the Black or Latinx or female GPs suck. It's because they had no opportunity and they never got a chance to produce in the first place. And so if you give, you know, if you take 100 pitches from white men and only 2 from 100% minorities, obviously you're going to be skewed in one direction. And I think the second point that Miriam makes is a great one too, around the GP commit. I think it's to me, it's the most exclusionary part of raising any private equity fund, period. And I kind of find it comical too when it's someone on the other side who has no skin in their own game in their in particular opportunity to tell me to double or triple or quadruple my commit. And it's also, it doesn't even correlate to our business, where if we told a founder, hey, I'll invest, you know, $5 million, but you have to put 15% in or 20% in, that fund wouldn't exist, because no founder would ever take your money. And so that to me is another big part of it. And then the last thing I'd say on that point is I was actually chatting with another institutional LP, must have been 2 years ago or so. I don't have the data on my hand, but he had the data that suggested that the GP commit actually had no correlation to performance at all amongst fund managers. And so I think if more and more folks can kind of get access to that data, understand that, it'll become less of a barrier of entry for folks, because if that data does suggest that, then it's pretty interesting to kind of share widely.
Great. Well, I just want to thank you all for your time. I can't believe we're already 60 minutes into this panel. I still have I think I still have 12 questions that I didn't ask and didn't use. But this is such a great conversation. And, you know, normally we'd be going into, you know, cocktail or a break where we can continue this conversation, but sadly we will have to end here. But I encourage all of you to reach out to any of these managers. You know, they're diverse. They span the spectrum of the private equity, you know, stages. So if you find one that, or one manager on stage today that you think, wow, like I need to learn more or about, you know, person X's history or method, please feel free to reach out to them. I think they will all be open to it. So thank you. And at this point, I am going to turn it over to my colleague, Kwesi Kwe, to moderate the Q&A session. Thank you all.
Hello, everyone. And thanks, Cindy. That was a really great discussion. My name is Kwesi Kwe, a senior associate at Fairview Capital, and I will serve as the Q&A moderator. I'm joined by Alan Matamata and Akar Vashani, both partners at Fairview Capital, as well as Tom Lopez, CIO of LAFPP. Just looking at the questions that have come through, and there's been some. The first question is as follows. How can prospective managers best work with LAFPP for consideration in the Specialized Manager Program? Tom, I'd love to hear your thoughts on that one.
Sure, happy to. We have two funds that help us with the search for our specialized managers in the program. So we have Fairview Capital and Portfolio Advisors. They function separately. Each has their own portfolio. And if there's an allocation, it only comes from one manager or the other. At Fairview Capital, Leslie spends a lot of time on our account, and you can contact her. For Portfolio Advisors, it's Todd Hughes, and we can, we can put up his email. I believe it's on our website by now, but we'll check. And we're happy to talk to people as well. So if people have questions about the program, and back when people are traveling, if they were coming by town, you know, we'd often, they'd stop by and tell us about their fund, and then we would send our notes on to both Fairview and Portfolio Advisors.
Great, thanks for that response, Tom. Just another follow-up. One of the questions that came through the chat is as follows. Have you considered LAFPP, that is, has LAFPP considered being a seed investor? And does LAFPP prefer to invest with managers that have co-investment capabilities? Any thoughts on that?
Co-investment hasn't been an important part of our private equity program. So whether someone has it or not is not a big deal to us. If by seed investor, they mean, say, an anchor investor, something like that.
Exactly.
We haven't done that officially. What we have done in some cases is that we were an early part of the fundraising cycle. So we would come in near the beginning of it. We offered to share our information, our due diligence with other investors and speak to investors as well. And so we've been told that that was very valuable. In terms of being an anchor investor, that's not something we've officially done. And quite frankly, the board is focused on returns as well. They would want a concession to be an anchor investor. It's been discussed at our board a number of times over the years. And so they would want a piece of the action, quite frankly. And if you can get away without doing that, that's a much better route to go.
Sounds great. Another question that came to the chat is as follows. What is Fairview's investment process when considering a fund for potential inclusion in LAFPP's Specialized Manager Program? Akar, do you want to take that one?
Yeah, sure. Thanks, Kwesi. Yeah, so process, I guess I can share our process, but it also involves LAFPP, which I'll touch on as well, but Tom, feel free to add. So the process starts really when we first meet a manager, and this usually happens can either through a network, our proactive outreach approach, which is based on our various research themes, but we also have a well-known open door policy, which aligns with LAFPP's philosophy. So like all our emails are right on our website, and that's intentional. So you can simply just reach out to us. Certainly Leslie, as Tom mentioned, or really anyone on the investment team at Fairview. And when we meet a manager, our goal is to really, get to know them. We try to build real, authentic relationships, try to be helpful with our feedback and counsel. And that takes time, as the panelists alluded to earlier. I can't tell you how many times we've had, taken a long time to build a relationship and end up passing on a firm initially, but then over time kind of get there, and are comfortable over time and find a fit as we build that relationship. So upfront, it's really about getting to know the GPs and their team and strategy really deeply. From there, the process kind of, for LA's program is similar to all our other emerging manager programs, which is where we do an initial screen, which is to make sure the strategy, the geography, the team, all aligns with our guidelines for the program. We have an initial deal team at Fairview, and so if there's enough conviction with that team to move forward, we end up doing a deeper dive, which includes like a fuller meeting, review of materials. We put together an initial report, and that's all presented to our investment committee. And by the way, like this is all an oversimplification of things, but each diligence plan for every manager we have is different. But so at that point, we generally, will lay out all the challenges and questions and concerns. And then it's up to the Fairview deal team to really address those in this second stage of diligence. And, we'll do there also like a bunch of quantitative analysis, as you can imagine, a ton of reference work, especially for younger firms. That's really important for us. We often rely on our own networks for that. We also do a full operational due diligence process that involves our finance and accounting team. And kind of passing all those things, we end up doing a full investment recommendation, which is put together, presented to Fairview's investment committee. Everyone on Fairview's investment team weighs in. So it's a super collaborative process. We have a culture where, everyone's comfortable speaking out. And so this involves everyone on the investment team, plus our chief compliance officer and our head of reporting. And ultimately, the way that we make decisions is through unanimous approval. Officially, it's unanimous approval from the Fairview partners, but really in practice, everyone at Fairview gets a vote, and we don't move ahead unless everyone is on board. And then after that point, with the LAFPP program, after a fund's gone through our process, there's a few additional steps, as Tom alluded to. We like to see the manager meet with staff. We also do a review of the opportunity with the staff to get their approval. And then we take every opportunity here to the board, who will then vote on whether or not they want to approve a commitment. So that's a process. Sorry for a long answer, but it is a long and thorough process. And there's a very high bar. And I think the process itself has been really effective in ensuring the program's success.
Awesome. Thanks for those comments. Another question for consideration here is as follows. Aside from the stated parameters, what other attributes does Fairview look for in a specialized manager? Alan, what are your thoughts on that question?
Yeah, so I guess maybe just to quickly rehash what the criteria are first. So, in order to be considered for the specialized manager program, there are a couple of different elements. So first, it's, the program's targeting the full spectrum of private equity. So that's everything from buyouts to growth equity to venture and to mezz and sub-debt strategies as well. And I think Cindy's panel had at least one manager from each of those categories. It also specifically targets first, second, third time institutional funds that are sponsored by the manager. There are also some size brackets. There's a maximum fund size of 500 million. Minimum fund size of 100 million into which the program can invest. And then very importantly, the program's looking for funds sponsored by management teams that are led either by minorities, women, LGBTQ individuals, and or disabled veterans. So any one of those criteria would qualify. Also worth mentioning, there's a preference, but not a requirement for investment strategies targeting LA or California. I know this is one of the questions that came up in the chat. You don't have to focus exclusively on LA and California to be included in the program. So those are kind of the specific criteria. And then, in general at Fairview, we have other kind of criteria that we employ more on the qualitative side. can the team cohere together? Is there a commitment to building the firm as opposed to just one fund? Does the investment strategy match the team's experience, et cetera? But the ones I went through earlier are, criteria specific to the LAFPP Emerging Manager Program.
Sure. Good response, Alan. Thank you. One of the things that I noticed during the poll segment was the number of first-time funds. And so I'm curious to know, and this is one of the questions that came through, how does Fairview conduct due diligence on managers without a traditional track record? Alan, do you want to maybe take a stab at that one?
Yeah, managers without a traditional track record. So I guess the first thing to say is, the program is designed to have maximum flexibility, right? So we want to include the widest possible funnel at the top, and that includes, managers without quote unquote a traditional track record. I think both Commissioner Vega and Commissioner Pendleton said it best. We want to have open doors, right, and engage with the funds wherever they are in their development, and so that's very important to mention. So specifically, how do we do diligence on them? When you have a non-traditional track record, I think it's really one of two buckets. One, you have a track record, but you don't have attribution, right? So your prior firm, either because of contractually aren't able to, or because you weren't senior enough, or just because you were investing on a team, you don't have a portable track record. Richard Kirby mentioned some of that challenge in his comment. So what we do there is, we do the work of talking to management teams, right, of the companies that you've been involved with, their syndicate partners that you've invested with, and we validate that attribution. So it's obviously not as clean as looking at, a track record on a sheet of paper, but we certainly have invested with managers after doing that type of work. The second type of non-traditional track record is you just don't have any investment history in your background. And there I would say the bar is obviously much higher. Our diligence would focus on, is there evidence that the team has excelled in a prior field? Does that level of excellence translate to investment success, right? Does the team understand that there are areas within their strategy that are not strengths for them, and do they have a plan to address it, right? Bring in talent or maybe partner with another established firm. We've seen that model done successfully as well. So those are some of the things, but I do want to reiterate, what I said at the outset is that we want to have the widest possible funnel here, and will not exclude non-traditional track records, for the program.
Okay. And then the last question we have here, and this is for everyone, does Fairview and LAFPP expect to deploy capital to specialized managers in the coming years?
Yes.
That's a resounding yes, right?
Yeah.
Yes. Yeah. No. The department had a disaster response plan that they built many years ago, and it wasn't exactly the disaster we were expecting, but the systems all turned out to work quite well, and so the department as a whole has been functioning just like we normally would. And so we're still having board meetings, people are getting their pension checks, people are getting to their disability hearings. And on the investment side of things, the only thing that has changed is instead of people before the board, they're now on a monitor in the boardroom. So the pace of our private equity investments is really just like it was before. So we are deploying more money, and and the year isn't over yet, and so there'll be more people coming before the board for decisions.
Mm-hmm. Yeah, and same on our end. I mean, we've had to transition to a virtual environment, which is often tougher with first-time funds, and especially groups that we haven't met in person before. But we're adapting, we're changing our processes. There's new elements to our diligence that we've brought in. And we've now, I think, officially made our first commitment to a group that we've only met virtually. So we'll continue to adapt and continue to deploy capital.
Okay. Well, I think we're a little past time, and there are still some questions that we haven't been able to get through, but I think that's okay. We'll be following up on any outstanding questions. Thank you to everybody here. This has been a great discussion. And with that said, I'll hand it over to Kola for some closing remarks.
Changes mind, he wants to speak.
So hello, everybody. I am Kola Olofibaba, and this has been a truly awesome event, particularly timely given the multitude of issues around diversity, equity, and inclusion that, while present as far back as one can consider, are particularly acute in the financial services industry and have really come to the fore in 2020. The Los Angeles Fire and Police Pensions have been and continue to be leaders in this space, and the Investing in Inclusion webinar today is a testament to the leadership that you have displayed in your investment activity. On behalf of the entire Fairview team, I want to thank everybody that took the time to attend today. Of note, we've had over 200 participants on the webinar. I want to especially thank the Board of Commissioners, and in particular, Commissioners Pendleton and Vega, who were here today and shared key insights that will be very valuable to all the managers in attendance. A special thanks goes to the wonderful staff at LA Fire and Police, including Ray Serrana, Tom Lopez, and also Susan Lim and Derek New, who we work with on a day-to-day basis. I also want to thank the general partners who participated today, Ivolis Rodriguez Simon at Avante, TJ Nahijan at Base 10, Richard Kirby at Equal, Takashi Moriuchi at Estancia, and Gus Albarelli at Sunstone, and Miriam Rivera at Ulu. And thanks to all other attendees, investment managers, entrepreneurs, and other stakeholders. Finally, a commendation to the Fairview team, especially Cynthia Sang and Leslie Nettles, who lead our activities with LA Fire and Police, as well as Damaris Rivera, Nicole Carey, and Kwesi Kwe, who were instrumental in the success of this event. We will be sending out a post-event survey. We would really appreciate it if you could complete and submit it when received. Thank you, everybody. Take care and stay safe. I am going to hand over very briefly to Commissioner Pendleton, who just wants to make a statement before we close.
Thank you so much. As we put a sort of final pin on this, I just wanted to lay out one ground rule here. My LinkedIn personally is on fire now. A lot of you have reached out to me, which I appreciate. I'm not sure if I'm on. I just, oh, there I am. I just want to reiterate that if you want to be involved in this process, please reach out directly to Fairview Capital or Portfolio Advisors. I personally can't help you and am prohibited from helping you in this process. I can guarantee you that the diligence process will be thorough. The diligence process will be hard. It will be time consuming, but we are looking for reasons to say yes. And GPs out there, those that we have invested in and those that we may invest in the future, I really encourage you to demand diversity from your own investments. Make sure the boards of the companies you're investing in are diverse. Be the change you wish to see in the world and pay it forward. And if there are any LPs on this call today, I encourage you to set up a manager program like this. And if you don't know how to do it, call Tom Lopez. We'll help you. We'll set it up because together we'll make all boats rise. And thanks again, Fairview Capital and the incredible staff of LAFPP. This has been a wonderful 2 hours well spent. Thank you.